So the key challenge now from I would say next 10 to 15 years of reform is that how do we increase the penetration of banking?
Banking plays a very central role in the development of the economy. And if India has to develop and get to its goal of Viksit Bharat, the banking structure has to support this aspiration.
And these banks used to suffer from a very high failure rate, something which is completely unthinkable today. But what has happened over a period of time is the market share has quite significantly changed. We have seen a significant market share shift from public sector banks to private sector banks. The kind of technology that banks operate in India is probably amongst the highest or best in banks in the world, right? For growth, the banks will require capital over the next 15-20 years. So that's a trade-off which basically is the main trade-off to be thought about in this context.
In the Union Budget this year, the Finance Minister announced the setup of a high-powered committee on banking for Viksit Bharat. Banking plays a very central role in the development of the economy. And if India has to develop and get to its goal of Viksit Bharat, the banking structure has to support this aspiration. This committee is expected to think about reforms required in banking in the country today so that we are set up in the right way for this aspiration. Today's open dialogue focuses on some potential areas that this committee could look at. For this discussion, joining me is Neeraj Gambhir. Neeraj, welcome to the show.
Hi.
So Neeraj, it's a very interesting topic. Maybe we start a little bit with the history of banking and how have we come to where we are today?
India's banking sector has undergone a very profound change since the independence over the last, say, about 80 odd years, right? Pre-independence, we used to have a lot of small, regional community banks. And these banks used to suffer from a very high failure rate, something which is completely unthinkable today. In order to stabilize the banking system, two things were done. One, Reserve Bank of India was set up in 1937. And in 1949, Reserve Bank of India was given the statutory powers that exist today in some senses, right? And the second profound change that was made was the passing of Banking Regulation Act of 1949, which basically, in some senses, started the process of regulation of these banks by the Reserve Bank of India. So a whole lot of things that banks could do, could not do, the charter of the banks, the various activities that they were allowed to do were kind of enshrined in that act. So starting from that point, I think India's banking sector started to take shape in its modern form. 2 or 3 more significant events happened after that. In 1955, State Bank of India was set up. It was earlier called Imperial Bank of India, so it was converted into State Bank of India. In 1980s, actually 1969, 14 large banks were nationalized. So that was during Indira Gandhi's time. And in 1980, another 6 banks were nationalized. So the period between 1969 to 1980s was a period of nationalization of large banks. Then came the reforms of 1992, which led to opening up of India's markets and privatization. And during that period, private sector banks were allowed to be set up. So the institutions such as HDFC Limited, ICICI, UTI were allowed to set up private sector banks. And subsequently, we have seen a few more things happen. One is consolidation of public sector banks. We used to have 27 public sector banks, now we have 12. There was also an attempt to create some form of specialized banks in the 2013-14 onwards. So besides the traditional full-scale, full-service universal banks, we also had new forms of narrow banks such as small finance banks, payment banks. If I were to trace the history of non-bank financial system in this period, in 1950s, we also had the setting up of development financial institutions. If you remember ICICI, IDBI, and IFC, right? And these institutions played a very significant role in terms of industrialization of the country, because these institutions were primarily tasked with the objective of financing new industrial units and new manufacturing units, etc. We have since then seen a significant change in that construct. For example, ICICI merged with ICICI Bank in early 2000s. And that basically meant that the traditional DFI setup that we had kind of gave way to a full-fledged banking setup. We have also seen, in some senses, a significant change in the non-bank financing companies, NBFCs. There used to be a large proliferation of these companies back in 90s, and that sector is also in some senses consolidated and expanded over a period of time. So if you think about banking as an activity of providing credit to the economy, so today we have effectively a 2, 3 or maybe slightly larger number of tier system. So you have full service large banks such as SBI, HDFC, Axis, ICICI. Then we have another layer of banks which is more regional, which is called regional rural banks, very local urban cooperative banks, and we have small finance banks, local area banks. We also have urban cooperative banks, and we have a fairly large number of NBFCs. Some of them are actually quite large, nearing the size of a mid-size or small-size banks. If you look at the full-service banks, you can basically divide them into two parts. Public-owned banks, state-owned banks, as we call them PSBs, there are 12 of them. Private sector banks, there are about 40 of them. As we speak today, roughly 55 to 60% of the share of assets of the banks and liabilities of the banks, which is deposits, is owned by public sector banks. So in that sense, while banking sector has undergone a significant change, it has still retained its dominant public sector characteristic in India. And that's something that may not change in a very near term. But what has happened over a period of time is the market share has quite significantly changed. In 2000s, early 2000s, public sector banks used to account for roughly 80% share of deposits and a similar percentage of share of loans. That percentage has now declined over the last 25 years to about 55%. So we have seen a significant market share shift from public sector banks to private sector banks. And today, as you very well know, HDFC Bank in terms of its size is comparable to SBI, and private sector banks such as Axis Bank and ICICI are comparable to some of the other large public sector banks. So in some senses, there is a fair distribution of assets now between public sector and the private sector. If you were to compare India's banking system with some of the global major economies, I think it stands out in the ownership of the state of this sector, because state still owns about 55% of the banking sector's assets directly. The only other country that you can look at from a comparison standpoint is China, which also has a very, very dominant state-owned banking system. Most of the other large economies, such as US, UK, a large part of Europe, banking sector is a private enterprise, right? It's completely owned by the private hands, and state has very limited sort of role to play in the sector, except for regulation, policy formation, etc. So in that sense, two large developing economies still contain or still run on publicly owned or significantly publicly owned banking system. That's where we are today.
Understood. Great. So just to summarize whatever you said, Neeraj, if you look at the banking system in India, we have the scheduled commercial banks, private sector and public sector, who do all kinds of activities. They serve all segments, they take deposits, they do loans. So They basically span the entire banking spectrum. Then we have urban actually cooperative banks, and we have RRBs, regional rural banks, who are doing the spectrum of activities, but they are very focused. They are focused on a geography. Actually, all of them are very focused on a specific geography,
Yep.
and they are cooperative. So, which means that they are kind of locally, they are serving local populations, and they are locally run and locally managed and so on. So we have those. Then we have some specialized banks. So we have payments banks and we have small finance banks. These came into being in the last decade post some new license types that RBI had introduced. So payments bank, as an example, they can't lend; they only can take deposits. And small finance banks can lend and take deposits, but they are supposed to do 75% of their business has to be in a very specific type of thing. Like they have to either fund SMEs or they have to fund only a geography or something of that nature. So we have those specialized entities, and then we have DFIs. DFIs were set up. These are typically not deposit taking; they are lending entities, and they have been set up to lend to a very specific area. So, as an example, ICICI and IDBI etc. were set up to finance infrastructure. We also have REC, PFC, who they are focused on very specific areas, and they are trying to fund, at least conceptually, they are trying to fund credit to very specific areas which have very specific needs. And then we have NBFCs, and we have all types of, we have retail NBFCs, we have SME focused NBFCs, we have corporate focused NBFCs, we have all types of NBFCs. These don't take deposits, but they lend, and then they will do all kinds of lending activities. So it's a fairly rich ecosystem in terms of the type of entities and the type of areas that they focus on, and that's where we are today. So now, Neeraj, if kind of moving from here, firstly, if we think of, as we think of reforms going forward, if you look back and think about 2-3 big reforms that have changed the banking sector and the landscape, what would those be?
So I think the big reforms, the really big reform was basically in the early 90s,
Right.
which was M. Nariman committee report. And that committee kind of set the path for privatization, liberalization of the banking system. India used to have a very state-controlled or regulatory controlled interest rate regime. So banks were allowed to set their own interest rates, banks were allowed to set their own deposit rates, set their own lending rates. A system of priority sector lending was also kind of set during this period, which has obviously undergone a significant change over a period of time, but it still fundamentally remains a component of directed lending in the Indian banks. The other big changes, it may not necessarily be called a reform or a big organized reform in that sense, but the fact that most large banks today are conglomerates, financial conglomerates, right? They all own, while the main business is banking, but the banking companies or banking organizations also have subsidiaries which are operating in non-bank financial areas. For example, they have subsidiaries in asset management, subsidiaries in insurance, right? So in some senses, if you look at large banks today, effectively all of them are financial conglomerates. That transformation has also happened over the last 20-25 years as the asset management companies and insurance companies have come about to own a significantly large chunk of assets, right? And have directly raised sort of money from the public. The key defining feature of today's banking system is you run a very classical deposit taking stroke lending style banking institution, but you also run other businesses which are in some senses compete with the deposits for savers money, right? And each of these businesses have their own sort of rich dynamics which are kind of playing out. Yeah, so those are the kind of major changes that we have seen over the last.
So one is privatization, which is the entry of private banks. Was obviously one big thing. The second thing that has happened, in addition to everything, which is not a reform, but one thing that has happened to banking in general is banks used to be very corporate heavy, pre, let's say 2005, and since then, kind of a lot of growth has happened on the retail side as well. And so now actually banks are almost equally, spread between corporates, SMEs, and retail. Both from from a lending perspective, deposits obviously were all over the place. Now, if we think, Neeraj, of from here, if we have to think about the next 20, 30 years, and 2047 is the kind of the time frame that the finance minister and the government have laid out for this Viksit Bharat agenda. So, what needs to happen in the banking sector to support our aspirations for 2047?
I think the first and foremost that you have to think about is the sort of penetration of the banking into the economy, right? One common metric that we all use is bank credit as a percentage of GDP. And if you compare India's bank credit as a percentage of GDP to some of the other larger economies, even some economies like China, we seem to be still at a very lower end of the spectrum. I think we are somewhere close to 55 to 60% of GDP in terms of bank credit, right? So which basically means that despite the reforms and the changes that have been made over the last 70, 80 years in the banking, core and essential banking services still not have reached to the level of penetration and to the last man in the deepest of geographies in India as it should have. And India is a large economy, it's a vast economy, geographically very distributed. So it's a task that is still sort of unfinished and will probably require some really innovative thinking to see how we can deepen the access of banking to across various parts of the country and deeper geographies in some senses. The second is that in general, I think it's perceived, may or be right or maybe not right, is the cost of intermediation for banks in India is quite high. And the reason why it is said it is quite high is probably two things. One, India has high statutory reserve requirements. We have about 4% CRR requirement. Then we still have SLR requirement, but LCR requirement has kind of taken over as the dominant sort of constraint, which basically means about 25 to 30% of banks' deposits are set aside in government bonds, balances with RBI or cash deposit with RBI, etc., which earn pretty low rate of return. On top of that, 40% of banks' assets have to be in priority sector lending, right? So effectively, those are also considered to be lower yielding, lower return assets, and this is directed lending, has to be done by each and every bank. And the interesting part in India is that while we have about 55% state-owned banks, the requirement of priority sector lending is applicable to all banks. Whether you're a public sector bank or whether you're a private sector bank, all of them have to comply with this requirement. Which basically means that the overall banking system has to set aside 40% of credit as priority sector credit. The third aspect of banking in India, which is actually quite interesting, is that the kind of innovation that we have seen, particularly on the retail payment side, right, has basically pushed the banks in India to adopt technology at a very, very rapid pace. The kind of technology that banks operate in India is probably amongst the highest or best in banks in the world, right? And banks in India have been actually pretty adept in terms of adopting this technology in some senses. So those are some of the key things that we see in the banking system as we speak today. So the key challenge now from a next 10 to 15 years of reform is that how do we increase the penetration of banking in the country while ensuring that the cost of intermediation stays low, banks are able to provide credit to the needy sectors of the economy at an efficiently priced credit. At the same point in time, banks have sufficient capital and they have access to the capital for the growth that is required in the banking system to support the level of economic growth, right? So how do you balance between these differing sort of competing sort of objectives, and how do you set regulation and policy in such a way that all of these factors are kind of supported?
Great. So if I were to just summarize what you said and add a few of my own points on top. So number one, for Viksit Bharat, banking has to penetrate further. This, loosely using the word inclusion has to improve. This is not just inclusion actually, it is penetration of
Yeah,
banking.
it is
So it's
penetration.
far more
I
than
prefer to
inclusion.
use the word penetration than inclusion.
So
right?
penetration of banking has to improve.
Yeah.
Our credit to GDP is actually quite low. There are many countries where banking credit to GDP is upwards of 100%.
That's right.
We are around 50-55%. So despite all the growth that we've had and the like, we still have some way to go. So first is a penetration of banking. And penetration of banking is very critical because actually GDP growth itself depends on credit growth, right?
Yep.
So credit growth supports GDP. It's actually, kind of one mental model that folks have is that if the GDP is growing well, credit will grow well. But actually it's a circle.
Yeah, the causality runs.
The
somewhat
causality runs the other way around
differently.
actually. So credit growth creates
Supports
GDP growth, supports GDP growth. And obviously when GDP growth is high, it kind of further supports credit growth. But credit comes first and GDP comes afterwards. So if the GDP has to grow, the credit has to grow. And typically credit grows slightly faster than nominal GDP. If our nominal GDP has to grow at let's say 11-12%, credit has to grow at maybe 14%. So credit penetration is one objective that the banking sector has to deliver over the next 20 odd years. The second point you made is this banking credit penetration has to happen at a cost of intermediation which is okay, which is what the economy can take. And cost of intermediation, Neeraj, is the difference between the deposit rate and the lending rate, right? So if you can get a loan at let's say 10%, and if the deposit rate, let's say 1 year FD is 6.5%, then the cost of intermediation is in this case 3.5%.
Yep.
Now is 3.5% the right cost of intermediation, or should it be 1.5%, or should it be 4.5%? Is the question. It can't be too high. Ideally, it is as narrow as possible, so that it is the cost of intermediation is not very high for the economy. So this is point number 2. The third point you mentioned was technology and the use of technology, etc., which then feeds into operational efficiency, which also, by the way, feeds into cost of intermediation, because that's one of the elements of intermediation that kind of comes and supports it. And maybe a fourth element, Neeraj, is which you also mentioned, which is capital. But if I were to broaden it, stability. That while banking credit growth is very critical, but banking stability is more critical. And so as credit grows and banking penetration grows, the banking system has to be very stable, and it has to be well governed, it has to be well capitalized, so that the economy has trust on the banking system, and that trust results in the compounding benefits of growth and so on and so forth. So that's maybe a fourth objective. So now let's take each of these, Neeraj, and try to dive in a little bit. Let's start with the cost of intermediation, because you already made 3-4 points there, and maybe those also feed into the others. So first, if you can help us understand this components of cost of intermediation, and where we are today, and how does it look, let's say, compared to some other economies.
So one way to look at cost of intermediation is net interest margins,
Right.
on which banks operate in India. And you see that typically public sector banks are somewhere between 2 to 2.5% net interest margins. Private sector banks are typically at a slightly higher net interest margin, somewhere between 3.5 to 4%, right? So that's one metric and measure to look at the cost of intermediation. There is a bit of a paradox, or there is a bit of a trade-off here that needs to be thought through, right? Given the fact that public sector banks have access to state funding for their capital, right? Or it's perceived that if required, the state will fund them. Public sector banks can typically afford to operate at a lower cost of funds, right? Or rather, operate at a lower net interest margin. So it basically means that even if their return on equity is not in line with what the market wants, they can still afford to do that because they have access to state. On the other hand, the public sector banks are entirely reliant upon equity capital which is provided by the market. And in a high growth environment of India, where banks typically compete with other industries for that capital, unless and until the bank's return on equity is healthy, it's highly unlikely that they will have access to the capital. The way to think about this is that how do you ensure that on the one hand the cost of intermediation comes down, which basically means that net interest margins come down, and on the other hand the banks are able to earn sufficient return on equity so that they can attract capital, because remember, for growth the banks will require capital over the next 15-20 years, right? So that's a trade-off which basically is the main trade-off to be thought about in this context. One way to think about that return on equity to net interest margin bridge is that if the operating expenses of the banking system can come down, right? And there can be many ways in the operating system expenses can be thought to come down, then probably the banks can afford to operate at a lower net interest margin while maintaining their return on equity equation, right? And that's where the technology and the use of technology in providing banking services becomes extremely crucial. Historically, providing banking services to remote areas or remote geographies has been associated with higher cost of operation, right? And that's why probably not many private sector banks have deepened their branch networks so much into deep geographies, because in and itself a single branch, while it takes a lot of money to set it up, may not have the sufficient size of assets and liabilities to justify its existence there, right? So how can we sort of reduce that cost of operation of the deeply penetrating branches so that banks can expand then their network at an affordable cost and increase their footprint. Other aspect is that are there any elements of regulatory cost which can be brought down? And one element to think about here is the priority sector lending, right? Because it also kind of creates a bit of cost overhead for the banking system. Whether there is another way to think about priority sector lending in the construct, which does not really weigh down so much on the banking system, and hence allows the banks to operate at a far more efficient cost of intermediation. These are some of the areas which really need to be thought through right. for the new next level of sort of reform and growth of the banking system.
Right. So very simply put, Neeraj, cost of intermediation is cost of lending minus cost of deposits. And if I would very simplistically think of a bank, and the bank is taking deposits from customers, and deposits will come in various forms. There is current accounts which are at zero cost, savings accounts which are, let's say, at 3%, and then there are term deposits which will come at 6.5%, 7% type of range. I'm using very simplistic numbers, it's far more complicated. But let's say the average cost of taking the deposit is, let's say, 6% or 5% for mathematical simplicity. So the bank has taken deposits at 5%, it has to give out 5% to the customers that it has taken deposits from. On the other side, the bank is lending at 8%. So the cost of intermediation is 8 minus 5, which is 3%. The reason the bank lends at 8% is 3 or 4. First is, if the bank takes 100 rupees of deposit, it can only lend 75 rupees. Again, very simplistically, because the other 25 is going either into CRR, which is, just the current account deposits that the bank keeps with the central bank, and then the rest of it goes into either SLR or LCR, and we will cover both of these in more detail subsequently. But for simplicity, if a bank takes 100 rupees of deposits, 4 rupees it keeps as cash in the current account, and about 20-21 rupees it invests in government bonds. Government bonds yield, roughly similar, maybe 6%, 6.5%. So they don't yield that much. So on that 25, we can assume that we are getting as much as we are paying the depositors. Again, this is, I'm just simplifying the math, but let's assume for mathematical simplicity, whatever I'm getting from depositors is what I'm also getting, or what I'm paying to the depositors is what I'm getting from here. So whatever now delta I have to make on the 75. So hence, there is a little bit of increase I have to do on the interest here. So this is number one. Number two, there are credit costs. Like if I give out loan of 100 rupees, then 1 rupee, 2 rupee, I will just lose because there will be non-performing assets. So I have to have some buffer for credit costs. Number three, I have my own operating expenses. I have to run branches, I have to pay salaries, I have to do technology investment, and so on and so forth. And so there is some OPEX as well. So I have to add that. And finally, actually, a fourth component which you mentioned is that while I am giving out 75 rupees, 40% of that 75 rupees is directed lending. Like I have to give out to priority sector areas.
Specific sectors of the
Specific
economy.
sector of the economy, agriculture, SME,
small farmers,
SMEs,
yeah,
etc., weaker section of the society, etc. And so typically on that 40, I would get a lower interest, and also they typically tend to be higher credit cost as well, and they are also more expensive to serve because by definition these are either remote areas or smaller customers and the like. So there is a little bit of delta I have to add for doing that, and then on top of that I have to ensure that I am making reasonable return on equity so that shareholders get kind of their returns as well. We are generating enough capital so that we can allow the next phase of growth. And so there are these four components that are basically coming into this cost of intermediation. Now let's take a couple of them and talk about them and see what ideas we have. So first let's talk about this, the statutory reserves, and if you can help us explain what those are and what is this LCR that you spoke
So India used to have for a very long period of time a regulatory regime which was basically cash reserve ratio of a certain percentage. Cash reserve ratio is nothing but non-interest earning deposit that you keep with the central bank, which is RBI, and then a certain percentage of your liabilities to be parked in government bonds as liquid assets, and those were called SLR, statutory liquidity ratio, right? And this setup of regulatory or statutory preemptions, as it is called, was very unique to India. Post 2008 GFC, it was realized that banks need to hold a certain amount of liquid assets, because in GFC it was found that the banks were over levered and did not have adequate cushion of liquidity on their balance sheet. So when the stress arrived, they could not find that pool of liquidity to help them go through a stress period.
GFC is the global financial crisis
of 2008, right? So post that crisis, Basel Committee, which is basically, you can say, a central bank of the central banks, came up with these requirements, which is called liquidity coverage ratio, which came up with a very complex model of determining how much liquid assets banks need to retain on their balance sheet so that they have adequate funding, adequate liquidity during periods of stress. So the way LCR works is that it looks at all your liabilities, all your deposits and other non-deposit kind of liabilities, and asks the question, how much of this money can actually go away in a 30-day stress period? And there are formulas around that. Certain percentages are applied to each and every class of deposits, and basis that formula, it arrives at a certain amount of what we call as high quality liquid assets, HQLA, that banks need to maintain. Now, unlike the old statutory liquidity ratio requirement of RBI for Indian banks, which basically said that for every deposit, every interest-bearing liability, in some senses, you need to set aside a certain proportion, say 18%, 20%, 25% as investments in government bonds. LCR is a somewhat more complex model. It basically looks at who that deposit is from, what kind of depositor has actually, and what is the behavior of this depositor during a period of stress. So LCR basically highly differentiates between the kind of depositors. If you're a retail depositor, I don't need to set aside that much money for high quality liquid assets. But if you're, let's say, a corporate or an institutional depositor, I need to set aside a far higher percentage for HQLA, which basically means that the money available for lending is that much lower. So in today's banking sort of day-to-day operations, or rather banking sort of balance sheet setup, what kind of deposit base that you have determines what kind of liquid assets do you need to retain. If you have a fairly large proportionality of individual, retail, low value, granular deposits, the amount of liquid assets that you need to maintain is far lower. But if you have a large proportionality of your deposits coming from corporates or institutions, your liquid assets requirements actually goes up quite significantly. So it's actually quite a kind of punitive to a wholesale funded or a bulk funded banking balance sheet. Nevertheless, on an average, if you see, banks end up maintaining somewhere between 20 to 25% of their entire deposit base as high quality liquid assets, which basically are investments in central government bonds, state government bonds, and to some extent some kind of corporate bonds. Because these bonds earn far lower rate of interest as compared to commercial lending, this portion of the balance sheet therefore creates a drag on the earnings of the banks, right? So this is the first, I would say, the cost element in terms of cost of intermediation. We call it the cost of statutory preemption.
Right. So again, just to summarize this, before the LCR regime, if as a bank I took 100 rupees of deposit, whether I took it from you or whether I took it from a SME or I took it from a large corporate or I took it from a financial entity, I would have to keep, let's say, 20 rupees in government securities. I'm again simplifying a lot, Neeraj. So that was the SLR. In LCR, if I take 100 rupees from you, then I have to keep, let's say, 10 rupees in the government securities. But if I took 100 rupees from, let's say, a large corporate, then I have to keep 40 rupees in the government securities. And by the way, if I took 100 rupees of deposit from a financial corporation, a financial entity, then the entire 100 rupees I have to keep in government securities. So what it means is that earlier, if I borrowed 100 rupees and I borrowed 100 rupees each from each of these, so I borrowed 300 rupees, so 20% of 300 is 60, so 240 rupees I could lend out.
That's right.
Today, if I take 100 rupees from all three, then 10 plus 40 plus 100, so the 150 rupees I have to keep in government securities. I can only lend out 150 rupees.
That's right.
And so from 240 to 150 is the reduction that I am able to lend out in the new LCR regime. In the example that
it's not necessarily in that proportion.
In the example that I gave, in the example, and my example is exaggerated, it won't be like this. But basically, the more you move towards the quote unquote less stable deposits, the more you have to keep in high quality liquid assets, which are typically basically government securities, government bonds, and hence the less you can lend out. And now if you have to make the same ROE, because your credit cost and the operating cost and so on and so forth is not that different, it means that the interest charged to that person will be a little bit higher. Or the bank is making lower ROE. Or it is passing lower deposit rates to customers.
I mean, I won't simplify it to that extent. What I would say is that in some senses, LCR is an alternative to our old SLR regime. Whether LCR regime lends itself to a far higher level of HQLA or lower level of HQLA depends upon what your liability structure is.
Of course, right? The proportion of deposits.
So if you are a largely retail depositor funded bank, it's actually beneficial for you.
Right.
But if you are a retail plus a large wholesale corporate deposit funded bank, LCR regime is more punitive to you. So this is actually, it's a global regulation in that sense. It is now adopted by almost all major jurisdictions, and all banks globally are subject to this regulation. So in that sense, it's a very universal regulation now. It kind of puts us at the same level as any other bank globally, whether it's from US or UK or for that matter any other jurisdiction, right?
Right. Now, since
But it's a, in some senses, India always had it. Now it's become a global cost, but it's nevertheless a cost.
Sure.
Right? And therefore this cost has to be addressed using how much you earn from your other parts of the balance sheet, which is your loans and advances part of the balance sheet.
Right. Since we'll come to the other costs also, but since we are on the topic of LCR, I wanted to go back to the credit penetration and growth point and talk a little bit about what's happening to deposits. And one theme that you hear, and we've done a couple of episodes on this as well, which is the, for the last few years, deposits have grown slower than credit. I mean, not secularly, there have been ups and downs, but in general, deposit growth has been slower compared to what we have historically been seeing. And secondly, the other thing that is happening is that A, the deposits are growing slower, B, the deposits are becoming more institutionalized, which is retail deposits are actually growing even slower and corporate deposits seem to be growing faster. So first, Neeraj, will be helpful to understand what's happening and why, and then we'll get the LCR discussion back and kind of look at what happens.
See, at the very macro level, deposits as a percentage of GDP is kind of an identity. Why it's kind of an identity? Because they have displayed a very stable behavior over a period of time. I mean, one proxy of this is M3 to GDP ratio, right? So M3 is the broad money supply measure, and broad money supply measure to GDP ratio has kind of exhibited a very, very stable relationship over a period of time. What does it mean? It basically means that for a certain level of economic activity, there need to be a certain level of deposits in the system. And those deposits can only exist in the banking system. They cannot exist outside of the banking system, right? So at a macro level, there will always be a certain level of deposits. The question is, where does this ownership of deposit lie? What we have seen over the last few years, particularly post-COVID, is that households who used to be a dominant owner of deposits of the banking system have started diversifying their savings into non-deposit instruments, into other financial instruments, whether it is mutual funds, whether it is insurance investments, and the like. So which basically means that the share of these granular retail deposits in the banking system are not growing at the same pace as the share of non-retail deposits owned by corporates. Now, how does this happen? We've seen and we've known that Indian corporate sector has over a period of time delevered itself. It is not borrowing as much as it used to borrow in the past from the banking system. As corporates have become cash flow generating, as they have relied on internal accruals for their funding, and there are certain parts of the Indian corporate sector which is basically services industry, right? For example, IT services providers. These kind of companies throw up a lot of cash in their day-to-day operations, and a part of that cash finds its way back into the banks as deposits. So effectively, what I call is there has been an institutionalization of deposit base in the country, and this institutionalization of deposit base is somewhat of a structural trend. We can't imagine Indian households going back to relying to the same level as they used to rely on deposits in the past, right? As the disposable incomes have increased, household savings have actually moved into different instruments because households are seeking better and probably higher returns which are available in the other parts. The second is taxation policy, right? In some senses, deposits in India attract a higher effective level of taxation as compared to some of the other instruments such as investments in equity and equity mutual funds. So fiscal incentive has also had a role to play in this shift. The long and short of this is that as the deposit ownership has changed away from retail, individual, household depositor to institutional depositor, and if you overlay the LCR regime on top of it, the effective lendability of the money in the hands of banks has actually reduced over a period of time. And this is a trend which has become quite pronounced over the last 3-4 years. What it basically means is that even if there is a certain level of deposit growth in the banking system, doesn't mean that the ability of banks to lend these deposits is as much. It's probably effectively going down over a period of time. And that's creating a kind of a structural impediment in the growth of the banking system. And as we think about next 20 years, we have to assume that this structural trend will continue. Therefore, we have to think about how banks are going to fund the kind of asset growth that they need to do over these next 15-20 years.
Great. So Neeraj, just to kind of put this in my own words, the overall growth of deposits itself has slowed for various reasons. Some of it linked to liquidity, some of it linked to forex flows, etc., etc. But the overall rate of deposit itself has grown. Second, if you just look at household savings, they've actually grown slower than nominal GDP, right? So savings itself has kind of come down. If you look at the stock of savings, as you said, there is a movement away from deposits into other asset classes. So savings have slowed, and kind of the mix has also moved. So that's a double whammy. Corporate savings have done well actually, and they've benefited. And corporate capex hasn't fully picked up, so it's not like they are spending that money. So corporates are actually saving a lot of money. And so the mix of deposits has moved very sharply away over the last 3-4 years. The data is very sharp actually, from retail to corporate. As that happens, if we come back to our LCR discussion, this is 10% outflow. This is at least 40% outflow, maybe even higher. So deposit growth may be 10%, but lendable deposit growth may be 8%. Which means that somewhere this is the multiplier of credit is reducing, because you can't kind of, earlier if you kind of give 1 rupee of 100 rupees of credit, it would come back as 100 rupees of deposits, and then you could give another, let's say 75 rupees after keeping the statutory reserves, etc. Now actually instead of 75 you can give only 70 or maybe 65. So the multiplier itself is kind of coming down, and that's a little bit of challenge to overall growth. And this is a trend, maybe some of this fundamentally changes, like corporates start to do more capex spends and then savings come up and so on and so forth. But at least at this point in time, it doesn't look like it's something that will reverse.
So the only thing I will say there is that while the corporate behavior may change, depending upon their perceived, demand, future demand in the system, the shift of households away from banking deposits into non-banking investment vehicles is something which seems like a lot more structural.
Right.
And it is also aided by the fiscal incentive that this has, right? So more and more people are now willing to invest in equity market directly or through mutual funds, because, for example, the tax rate on long-term gains is far lower than tax rate on income from fixed deposits.
Right.
And that's the fiscal incentive part of it, right? Unless and until that fiscal incentive changes, I don't think this behavior is likely to change. And so that sort of trend is likely to continue. Corporate behavior may change towards investment, may not change towards investment. This is an underlying trend that we need to deal with.
No, absolutely. And hence, as we think of the next phase of reforms, one of the things to think about is the banking operating model, which was deposits from retail customers and corporate customers, will look very different in the future. And so how does banking support growth of the economy in this context is a topic to...
So that's a key thing to think about. One more area that we've not discussed so far is the share of low cost CASA deposits. Right. If you see the spread of any bank, I mean, typically we say that Indian banks have approximately 35 to 40% of their deposits coming from current and savings accounts. Now current and savings, current account you don't pay any interest. Savings account you pay interest which is much lower than term deposits, and the rest of it is term deposits, right? So if you look at today's context, we pay about 2.5 to 3% on savings depending upon banks. There is the interest rate that is paid on term deposits roughly 6.5 to 7%, and current account obviously is zero. That gives you, with a 60-40 ratio, that gives you a blended cost of funds of about 4.5 to 5% for the banks, right? As the propensity of households to invest more in other instruments actually increases, and also the fact that the payment system in the country is becoming more and more efficient, the pace of growth of CASA deposits is also coming down, right? So today, for the last several years, we've seen that while deposits have grown at X, CASA has grown at a rate which is much lower than X, right? What does it do? It basically effectively increases the cost of funds for the banking system. Even though the interest rates may not change, for the same level of interest rates, because the low cost CASA deposits are coming down, the cost of funds is going up. So that's the other trend, and it seems like again a structural trend, because economy is becoming more efficient, individual agents are becoming more efficient, there is more liquidity in the hands of corporates who are not necessarily keeping it in current account but sweeping that money into mutual funds. That is becoming more efficient. So all of this is again another underlying trend that has to be thought through.
And I think one place where this is very visible is the government space actually.
Yeah.
The government themselves have become, and they've kind of
Yeah,
moved
so
away
the government used to keep a lot of balances with banks, and as government has shifted its banking into a centralized, central bank RBI driven payment system, the amount of government deposits that were lying with the banking system have actually come down over a period of time.
And so these kind of trends will continue. And one topic to think about is, how banks raise resources
Yeah.
in a way that lendable deposits
Yeah.
grow at a rate which can then, allow for the credit multiplier and then allow for the economy to grow itself. So one very interesting area. And we covered taxation and the like as well, right? How do we get the right treatment for deposit versus equity and so on. So maybe then we'll move back to the cost conversion. We spoke about the statutory costs.
Yeah.
So that's kind of one piece, and then there were the other pieces. So why don't we move on to the?
So the other aspect is basically cost of operations.
Yes.
Right. Cost of operations is basically what you have to incur because you run a large branch network. You're also banks are supposed to invest heavily in technology, so there's a technology cost that banks have to defray, and banks typically end up using third-party service providers. For example, in case of retail assets or mortgages, you typically operate through DSAs as they're called, the intermediaries, and so there is cost of that. So there is this cost of doing business, which has to be managed over a period of time for the overall cost to come down, right? So the cost of operation of Indian banking system is something that needs to be thought through as to how it can be made more and more efficient over a period of time. The only way that one can do this is adoption of technology, right? And ability to use technology to provide many of these services. We all know AI is making a significant impact, or is likely to make a significant impact on the banks, not just on the banks, but all parts of the economy. But I think the usage and the adoption of AI by the banks is going to be one crucial factor in bringing this cost of operation down over a period of time.
Right. And the kind of a little bit of a perplexing but fascinating fact is that if you take like the last 7-10 years, the costs of banks hasn't moved that much, despite the usage of technology going up very, very materially. If you look at cost asset or cost to income, they are pretty much, there is a little, obviously it's not that there is none, but it hasn't seen a significant decline.
Part of the reason is that one of the key areas in which banks have been investing in technology is payments. So while the country has adopted retail payment system like UPI in a big way, it's non-remunerative for the banking system. So the banks have invested in technology, but they haven't gotten any return. There are no user charges for UPI that banks make for providing these services. Likewise, if you think about the new sort of area of investment for banks is protection against cyber fraud and digital security, right? Even that requires significant investment in technology, but that's not necessarily going to give you that incremental return that would have otherwise come, right? So investment in technology has become, effectively I say banks have now steadily started to become technology companies, right? That's the level of investment that banks are required to do. But is it necessarily resulting in a better return metrics for the banks? Answer is probably no.
Yeah, and also over the last many years, the costs of compliance, etc., also have gone
also
up
gone up,
very
yeah.
significantly. And so, there is some benefit coming through here, but then there are other kind of costs coming in as well. So that's a conundrum. The last one, or the third area on top, Neeraj, is this the priority sector lending and the directed lending kind of area. So why don't we kind of talk a little bit about that and what that?
Yeah, so I think priority sector lending is a bit of a holy cow in our industry, because given the government's focus on providing some sort of low cost credit to the needy sectors of the society, right? Whether it is agricultural, small and medium enterprises, bottom of the pyramid, sections of the society, banks have effectively been doing a social function in that sense. And I don't think that social function requirement of the banks is likely to go away anytime soon, because it's a politically sensitive topic. At the beginning of this episode, I mentioned that priority sector lending in this form is very unique to India. I don't think there is any other parallel anywhere in the world where even a privately owned commercial bank is asked to maintain a certain amount of lending to this section of the society, right? And typically it's called directed lending. I mean, directed lending is something which is an old feature of state-owned banking systems in the world. Now, the question for us, and this is the key question for maybe this committee that has been formed, is how do you make sure that banks are able to satisfy this social function requirement, right, a social objective requirement, at a meaningfully low cost with far lesser burden on their balance sheets as it currently exists? Because given the cost of doing this side of the business, it has to be recouped from the other side of the business, right? So which basically means that you necessarily have to price your loans to corporate sector at a higher level, because you need to recover this cost from that side of the business, right? And I think one needs to now start thinking about what are the alternative models of giving this priority sector funding, rather than asking banks to directly do it. And there are several that can be thought about. One of the ways in which you can do this is that if you have, let's say, the obligation on banks of lending certain amount of money to this sector, converted into obligation of contributing a certain amount of their profits into a different fund. And that fund in turn underwrites or provides the credit guarantee for doing that business. So effectively what you do is you basically allow banks to do whatever they want to do from a lending point of view, but contribute a small amount of profits to a fund which then in turn incentivizes this kind of lending. That could potentially change the way banks function and change the way banks sort of intermediate this side of the system, and maybe brings down the cost of this intermediation, right? But the point that I'm making is that the current model of priority sector lending has existed for almost 50-60 years in the Indian banking industry. It has served some purpose, but it is not clear whether it is serving the entire purpose with which it was set up, right? And therefore we need to think of alternative ways of providing this functionality.
So Neeraj, the current PSL, just to kind of explain, so currently if the bank has lent 100 rupees last year, what is called ANBC, but very simplistically put, if the loan book is 100 rupees last year, then this year I need to lend 40 rupees into priority sectors, and the priority sectors are there is agri and non-agri, and the agri part of priority sector is 18%, which means 18 rupees has to go into agriculture, of which 10 rupees has to go to small and marginal farmers. 4 rupees, incremental 4 rupees needs to go to non-corporate farmers, which is farmers but they have larger land holdings. And the last 4%, the last 4 rupees can go to corporate entities which are dealing in agriculture and agriculture supply chains. So that's the current kind of way of doing PSLs. If we don't meet any target, like as an example, let's say the small marginal farmer, we are able to lend only 8 rupees, then the additional 2 rupees I can buy as a PSL certificate from the market, or if that shortfall exists, then I'll get some RIDF allocations from NABARD or Shetty or the like. So that's how it is done today. Now, particularly the place where banks find it most challenging is the agriculture sector. And one of the things about this is that this kind of architecture has been there for a number of years. And if you think about it, the banking credit has grown by about 14-15% over a long period of time, whereas agriculture GDP has grown only at 4-5%. And so there is a little bit of, kind of excess credit moving into, or the growth rate of credit into agri is probably higher than the GDP of agri itself. And so one question is this: is it the most efficient allocation of credit, because this 40 rupees is directed? And the second question, as you said, is that if there is a certain cost and certain interest income out of this, then to get to a certain ROE, some other element has to contribute, which then results in a cost somewhere else. And there are some interesting ideas that you shared on how we could think of a different way of managing this. But this is an area for us to think about for the banking sector for the future. So we covered growth, which is the deposit rate and the growth rate of deposits, and how do we create the right resources in a situation where household deposit seems to be shrinking. We covered the cost of intermediation elements, which is statutory cost, the LCR and the SLR and the like, and also the priority sector area. The other area we'd spoken about was capital and ownership. So for the banking sector to be robust and to grow, it needs capital, and it needs newer forms of entities to come in as well. So one area, Neeraj, will be great to get your thought is A, on ownership of banks, and B, on entry of new entities as banks.
Yeah, so this is an area which has attracted a lot of debate in this country for a long period of time, right? Historically, while if you go back to the pre-1949 era, banks were privately owned merchant organizations, mercantilist organizations, commercial organizations, right? Since the onset of, I would say, the socialist era of 1960s and privatization of the banks in 1960s, they became state enterprises, right? And then we saw a period of reforms where the ownership sort of shifted partly from state to private sector. But look at the kind of entities which promoted these banks in the private sector. They were basically financial institutions, even though they were effectively privately owned financial institutions, but nevertheless financial institutions. We haven't really allowed corporate sector to own banks in this country, right? There are many parts in the world where corporate sector, industrial organizations or manufacturing organizations own banks within their overall conglomerate setup. But India has very, very deterministically stayed away from that kind of structure. And part of the reason we have stayed away from that structure is that there is a perceived conflict of interest between a corporate, owning a bank, whereas the bank's resources can be diverted to the corporate, and you can have a lot of conflict of interest situations. So in this context, banking institutions and banking organizations in India have largely been very focused financial institutions, not having any other line of the business. The Banking Regulation Act also very tightly defines what a bank can do cannot do, and there is very strong boundaries around venturing into non-banking areas of business. So one key question that has been asked repeatedly is that if we have such a narrow set of ownership restrictions of banks, and if India does require a significant amount of capital to go into banking industry, because you need to have a certain size and sort of heft of the banking industry to support the economy's growth, where is that capital going to come from, right? Because as I just mentioned, 55% of banks are owned by state, and state has a limited capacity to basically provide capital to these banks, because India also is a very large fiscal deficit country effectively, so you can't keep on dipping into the to the state's resources to keep on funding the growth of the balance sheet. So how is the funding of the banks come in? Not a settled debate at this point in time, right? We continue to have these discussions again and again, and very recently, if you see, we are seeing a perceptible shift in terms of accepting larger foreign ownership for certain kinds of banks. So that's also recognition of the fact that we do require capital in the banking sector. If it is not coming from domestic financial institutions, and there is a constraint on the fact that corporates in India cannot own banks, state itself is constrained because of its fiscal deficit considerations, then that capital necessarily has to come from outside. So we have made that, this is a new experiment in that sense of allowing foreign ownership.
So, we've had two big, actually three. One is obviously Yes Bank, where SMBC has come in as an investor, and the second one is RBL, where ENBD has come in as an investor. There's also Shriram, which is not in the banking sector, but we've seen some action there as well. Yeah, but please go ahead.
And the fourth one was IDBI, whose privatization was being talked about.
Right.
It's being put on hold. We will get started again.
Right.
But clearly, this is a new direction that we seem to have taken in terms of ownership of banks. The interesting aspect of Indian banking is that, unlike many jurisdictions, foreign banks in India have remained, foreign banks or foreign banks branches in India have remained a very, very small player, effectively from a size of assets perspective, right? And very, very niche player, more focused on corporate and investment banking than retail banking or commercial banking. And it's not as if they are very keen to sort of increase this stake, because we did experiment with a wholly owned subsidiary structure for foreign banks. If you remember, DBS converted itself into a wholly owned subsidiary, but it's not as if the bigger foreign banks have jumped onto this bandwagon and said, okay, we want to become a wholly owned subsidiary and want to put in a lot of capital behind India, because these banks are consolidating in their home jurisdictions, particularly after the global financial crisis. So the key question that we have to answer is that if the banking sector has to grow, and we need to have somewhat more sort of competition in the sector, or even for the existing banks, they require capital. Where is that capital going to come from, right? And who's going to support this growth from a capital perspective? I think the answer would lie potentially in saying that eventually that capital has to come from broader equity markets. And if you need that capital from broader equity markets, then you need to make sure that these banks are earning a certain level of return on equity, otherwise equity markets are not going to be interested. And if you have to earn that return on equity, then all the components that we discussed above, which is basically the cost of deposits, the cost of operations, the credit costs, have to line up in such a way that these banks are able to earn, or the banks are able to earn a meaningful return on equity.
Right. The last area, Neeraj, is so we covered growth, we covered costs, we covered ownership and new entry, etc. Last area I thought also interesting is that we did an experiment with specialized banking licenses, payments bank, SFB, etc. Is there case for a second attempt at this in a different format?
See, one of the theses of specialized banks is that if you think about a universal banking model where each bank is providing full range of services to its customers, the banks need to operate with a meaningful size and a meaningful network, branch network or geographical distribution for it to make sense, right? Because let's say if you want to do retail lending, you need to have a retail deposit base, and you can't get the retail deposit base unless and until you have a meaningful geographical network, which basically means a certain amount of capital is required for a bank to scale up. Whereas you could also have banks which pursue somewhat more specialized area. For example, you could have banks which just focus on wholesale banking, right? Not necessarily create the kind of spread or not necessarily require the kind of spread that a retail bank requires. So could you have banks focused on just a niche area of business rather than doing the full service bank? We experimented with this in the form of a payments bank and in the form of a small finance bank. The idea of small finance bank is it's very local, very community based, and it doesn't necessarily follow the same wider spread, and hence maybe can operate at a lower capital and a lower cost. And the second idea was a narrow bank of a payments bank whose job is just to facilitate retail payments, right? Well, these ideas and so there a number of licenses have been given in this space. I think the jury is still out whether these are successful business models, right? And whether these models have been able to scale up to the level where they can actually go and raise significant amount of capital and then continue to operate in this area. But beyond these two forms of specialized banks, we haven't really experimented, and therefore in the next phase of India's growth, we could potentially look at more specialized form of banks which are just focused on a particular area. For example, you could have a bank which is just focused on SME business, right, and not necessarily doing the whole range of assets and liabilities that a typical commercial bank would end up doing.
Great. So Neeraj, we covered a broad range of topics. We spoke about the history of banking, and we spoke about what areas need to be covered so that banking can support Viksit Bharat. And there we spoke about the credit penetration is a critical metric because we are way off compared to some of our peers or some of the countries that we would like to aspire to look like. And credit is a driver of GDP growth. And if India has to grow at 7-8% over the next 20-30 years, credit has to grow at higher than nominal GDP growth rate, which means that the credit penetration has to increase. And for credit penetration to increase, two key areas. One is capital, because only when capital exists then credit can be given out. And second is the deposits growth. We discussed about that, and particularly in the context of household deposits not growing at a high enough pace, compounded with the LCR regulations, which then have higher quote-unquote penalty for corporate deposits. The question of how banks garner deposit resources so that they can support GDP growth is a critical area to think about. Second, we spoke about the cost of intermediation, where we spoke about statutory costs, which is again similar LCR and what that does, and the deposit mix changing basically means that there is a higher cost of intermediation. Secondly, we have priority sector lending, which is direct lending, and that further adds to the cost of intermediation. And the last element is the cost of operations. And so one of the areas that banking needs to do going forward is provide the credit impetus through higher credit penetration, but to do it at a reasonable cost. And again, for that, these two areas need to be thought through, and some kind of thinking has to happen on how the cost of intermediation can be reduced as well. Third, we spoke about capital and ownership, where we are obviously trying these experiments of getting foreign banks to come and invest in large amounts in specialized situations. But then a lot of the equity capital has to come from broader equity markets, for which again banks have to have reasonable ROEs, which means that we have to solve the problems that we spoke about as part of the cost of intermediation anyways. And lastly, we spoke about specialized type of institutions. There is perhaps, for the growth to continue, there is perhaps the need for some specialized type of banking institutions as well. which is another area that this committee could consider and think about.
Yeah.
So we've obviously not covered all areas. I'm sure there are many other areas that the committee will think about, but we've hit some of the high points, and it'll be interesting to see how we progress from here. Thanks a lot, Neeraj, for your
My
time.
pleasure.
Thank you for listening into this episode of Open Dialogue. I hope you enjoyed this as much as we've enjoyed bringing it to you. We are overwhelmed by the response that we've received and really look forward to your comments and feedback. Do like and subscribe to our channel to keep track of new episodes that are coming through. Thank you.